Good day to our viewers. Welcome to Analysts Insights. On this program, we discuss all things capital markets, focusing mostly on our market today. And I'm usually with my colleague Rufaro discussing more like a dialogue, the two of us. But today is a special day because we are joined by the corporate actors, the corporate executives from one of the listed companies on the Zimbabwe Stock Exchange. I'm joined today on my right by Kiran Makshere, the Managing Director of First Capital Bank, Zimbabwe Limited. And on my left, I've got Fano Kapanje, the Chief Finance Officer for First Capital Bank. Welcome to the show, gentlemen.
Thank you. Thank you. Pleasure to be here.
Yes. Rufaro, don't be jealous. Welcome to the show.
Thank you for having me, and welcome, guys. It's a pleasure to have you on.
Thank you.
Yeah.
Thank you.
So this discussion is coming on the back of your publication of your results and also the analyst briefing that you had quite recently. And we just thought maybe let's discuss, dive deeper into some of the issues that you highlighted to the analyst community. And maybe to get us started, Kiran, maybe you can just give us a rundown of the key highlights from 2022 from the FCB end and how that sort of informs the kind of presentation and the results that you produced.
Sure. Probably to start with, probably worth giving a little bit of context in the history. And
Yes.
we may go into this a bit more as we get into the conversation. But, we spent the first couple of years of First Capital life, if you like, migrating away from the Barclays infrastructure onto the First Capital infrastructure, which I think probably held us a little bit back behind the market. And with that complete, it's allowed us to focus now on trying to get up to date in terms of delivery.
Okay.
So to me, one of the big operational highlights last year was actually the number of things we delivered
Okay.
from a product channel perspective.
Okay.
We launched a new Gold Card last year, which allows our customers to transact in Nostro, but not just in Zimbabwe, but overseas, buy online, etc.
Okay.
We launched a new mobile app primarily for our retail customers.
Okay.
Internet banking, we launched a new internet banking. We've started to integrate with some of our customers in terms of host-to-host, linking our banking system to the customer's general ledger.
Okay.
We also, we're just developing, and it will come out this year, is a new point-of-sale machine. So there's a lot of delivery in the last year that I think brings us more up to date. We still have a lot of work to do. We continued on a cultural journey to try and migrate away from that Barclays to the First Capital culture. And in terms of results, we've seen that come through in the results. We've seen our balance sheet grow. And again, I know we'll come into that in more detail, but both our deposits and our assets have grown significantly above inflation. Our operating profit has grown significantly above inflation. And the fact that we are also comfortable on a core capital basis allows us to pay dividends, which is what we've been doing for the last couple of years, which is great for our shareholders, the first return in terms of dividends they've had in a number of years, but also for our employees who are 15% shareholders in the bank. So they share in the growth and the journey that we are on.
Okay. And for you, Fano, what did that translate into in terms of the numbers? What are sort of the key highlights that you'd want the viewers and the investors to take note of?
All right. So from what Kiran is talking about, right? I think we've really just created maybe let me call it an enduring premium beyond just the numbers that we're talking about. Here I'm talking about the growth in the customer base that has actually happened during the period. Just in 2022 alone, we talk about a 48% growth in the number of customers on book, and that should speak to the quality of some of the services that we're deploying out there to the customers. Then, in terms of numbers, what that translates to is a profit, in real terms, for 2022, something in the region of about 8.3 billion, which is a reduction, of course, from what we posted in 2021. But that ought to be understood within the context of the value destruction that is associated with hyperinflation, with 234% annual inflation for 2022. In our case, the monetary loss, the cost of that inflation on our book is actually quite a significant figure, something in the region of about 6.5 billion.
Okay.
One thing that we quite proud of when we look at that income statement is the fact that when we then look at our profits and strip out things like revaluation credits that are coming on book, we're actually seeing an improvement in profitability on an annual basis in inflation adjusted terms. So the growth for 2022 is actually 57% when you just focus on that metric, which is actually speaking to some level of resilience on the income statement itself, and actually real value creation on a progressive basis. We've seen a significant part of our balance sheet converting to foreign currency. Our deposits and the advances, they actually more than 70% in foreign currency.
Okay.
And that's beginning to respond, as far as the income statement side of things is concerned. Of course, within the formal sector, a significant chunk of transactions we see are still in dollar denominated. But for 2022, total for the year, 37% of our total income, came from foreign denominated, sources, which is actually an improvement, quite significantly so, from about 13% in 2021, and that's a story we think is going to, continue into 2023. Then, as far as some of the key metrics that we track, we notice an improvement in our cost-to-income ratio. Of course, bearing in mind some of the technical credits that I spoke about earlier on, we strip those out, we end up in a situation where the cost-to-income ratio becomes a little bit higher than we talk about. I think for 2023, we're talking about 56%. With a positive, operating jaws, meaning that on a total basis, the total revenue would have increased at a faster pace than the expenses. But of course, strip out the technical credits, the situation becomes a little bit different. And as we go forward, cost management becomes a very, critical component.
So if maybe to interject, or at least you are talking about the cost-to-income ratio, maybe one would ask and say, how realistic are the cost numbers given the hyperinflationary environment, and the fact that in those costs there's a component of it which is US dollar and a component which is Zim dollar. So maybe as an investor, you want to try and ascertain the sustainability of your cost-to-income ratio.
Yes.
Is it not a cost that maybe because of this, the current mix, one could possibly be benefiting from paying lower costs in one currency versus the other? How sustainable are the cost-income ratio numbers that you are achieving right now?
Yes, indeed, you are right. And this is the reason why for us costs become a major strategic focus area as we go forward. But within an inflationary environment, as far as costs are concerned, there is always pent up pressure for cost expansion. You generally find a significant component of that cost base adjust on a deferred basis, if I'm making sense. And therefore, what it means is that yes, we would have achieved the levels that I'm talking about, but as it is, as we look to the future, we're going to see catch-up adjustments on some of the, the cost lines. I think one that I can give you As an example, is staff-related costs, where at the NEC level we're actually getting adjustments coming in on a quarterly basis for 2023.
Okay.
That obviously creates pressure from a sustainability point of view. So yes, we don't sit on our laurels and say we have achieved this cost-to-income ratio, therefore we stop there. It is very, very important, particularly at this present stage, for us to ensure that the cost base itself is actually moderated, to a point that we can guarantee future sustainability. We're seeing, on the revenue side, and of course, there's the economy, transitions with a lot of transactions going into foreign currency. We're seeing that the volume of transactions transacted on the formal platforms in the banking sector tends to reduce, because a lot of foreign currency activity is actually not quite in the formal sector. That reduces our earning potential
from the foreign currency deposits.
Precisely. And that's becoming the de facto sort of base that we're going to be operating on as we go forward, isn't it?
So what needs to happen for maybe from a strategic point of view, Kieran, just to chime in, what needs to happen for the customer to start transacting on your platform and maybe move away from the current situation where pretty much everyone is withdrawing their foreign currency as soon as it is their account and they start transacting in the informal sector? What are you doing as a bank, and what are banks doing to try and capture that transacting foreign currency in the informal sector?
Yeah, no, it's a good question, and it's a difficult question to answer.
Okay.
But there's a couple of fundamental issues there. You've got to ask yourself, why are people transacting in dollar cash and not actually transacting the same way in dollars as they do in ZWL? Why are they happy to swipe in ZWL but not in dollars? Why are businesses not encouraging customers? You have to ask those questions, okay? Then you get underneath it, and there's just 2 or 3 reasons. It's clearly a question of confidence. Okay? Confidence in the sustainability of a dollar on a multi-currency environment. That's out there, given the history of what's happened. You also have the reality of 2 things: is a liquidation of domestic nostra, 15%, and on the export side it's 25%. And as you get the widening of the parallel, it disincentivizes people to bring money through the banking system. They're probably the two key things. There's also, I guess, an infrastructure perspective in terms of making sure that we as a banking industry, which is coming, have a robust platform that people can swipe and can actually transact easily and efficiently and at an affordable level, which I think it's almost there now. It's almost there now. But I would say it's the first 2 things I've talked about: the confidence and that liquidation and a gap between efficient and parallel, which I know the authorities are working hard to try and make sure they keep that as close as possible. But there are issues in my mind in why people move to cash as opposed to through the formal banking sector. But just to finish on that, remember also, what is it? We can guess. Is it 80% of this economy is in the informal sector? When you think about that, 80% of the economy is informal. Where's the incentive to bring money through the banking system, what's in reconciliate, etc., etc.? You start to look at that aspect as well, and that's a big challenge as well.
Yeah, but also just maybe to add on that, Kieran, I think you generally find that a recent history of hyperinflation breeds elements of mistrust. And I think in our case, there is the hyperinflation. Then there is also the way in which the dollar environment of the recent past transitioned into where we are today. And I think those elements together, get to breed a lot of mistrust. And I think a lot depends on how policy evolves as we go forward. And it's not something that's left to just one institution or perhaps to the banking sector alone. I think it's really something that is that's got to be backed into policy formulation as we go forward.
So one of the challenges that we in the analyst community have when we look at your numbers and try to wrap our brains around them is, working with hyperinflation figures. What does it mean? This 50% growth in inflation-adjusted numbers, and particularly in the context of comparisons with other institutions, because you spoke to FCB having 70% of its deposits in USD, the balance in
Zim dollars.
Mm-hmm. Different institutions will have different splits.
Yes.
So when we look at your 2022 numbers and compare them with another institution, we don't know, what judgment calls were made to convert those US dollars figures into Zim dollars, and there's all sorts of judgment calls that are made in putting together hyperinflation accounts. It's not clear upfront that you are all using the same assumptions, so it becomes quite difficult to just within FCB, just comparing your 22 numbers to your 21 numbers.
Yes.
And to compare them with other institutions. So is there, going forward, is there going to be supplementary information, that you as FCB are considering, and maybe just the industry is considering, in terms of other metrics that we can use that are not subject to the vagaries of currency issues and hyperinflation, like customer count and I don't know, but I think that.
I think it's a very fair question. Let me start, and then I'm going to throw over to my friend here, because he's also chair of the Bankers Association Finance Committee, so he can answer some of these questions.
So we'll go the right person.
But in terms of, let's just talk about the exchange rate. We should all be using the exchange rate. Yeah, I think the generally across the market, I think everyone moved to the willing buyer, willing seller rate as a point of valuation. I'll talk about the banking industry at the end of last year. I think there's very few, if anyone, who stuck with the auction rate. But even if they did, it's not that big, because the auction rate changes weekly, the willing buyer changes daily. So that's one aspect that gives you a little bit of consistency.
Okay.
Then on the inflation numbers, we've tended to use the CPI rate. And
now it's a blended rate.
Well, I will come on to that in a second. I'll come on to it. So using those, you have comparability. The real question in my mind is, how robust or how accurate is that CPI rate? Because the idea of inflation accounting is to actually strip out the noise of inflation. So you're looking, you restate your numbers from prior year, so you're looking balance sheet to balance sheet, like for like. Okay, so it really comes down to a question of how robust and how confident are you in that CPI rate. Then you talk about the blended rate. That's a problem. That's a real problem. Because from an accounting perspective, you've got a functional currency. If you have a blended rate and you're reporting in ZWL, or even a blended rate and you're reporting in dollars, it's very difficult, and that's a challenge from my friends in the. Thankfully, I've left the finance industry, but my friends in the accounting. Well, let Franwell, you come in and add to what I've just said.
Yeah, I think, Kieran, you're spot on, and I think really it's in the nature of inflation-adjusted financial reporting that you probably won't be able to eliminate all the noises that you've just mentioned. They are a characteristic of reporting within a financial an inflation-adjusted context. And there's been some discussions on the market around how that reporting can actually be enhanced, perhaps through additional disclosures. And I think I would urge analysts to interrogate fundamentals of the business a lot more than just focusing on the numbers. That's why in our case we then also tend to track growth in terms of what the underlying business is actually achieving at the end of the day. So in our case also, as we go forward, you would be aware that we will soon be listed on VFX. We hope that by that migration, the reporting that we'll be doing, which is largely going to be in a stabilized currency, will probably become a lot more meaningful. I don't suppose that we will eliminate all the noises that are associated with hyperinflation, what exchange rate to use and stuff like that. But I think we'll probably move into a situation where that reporting becomes a lot more meaningful, a lot more sensible, than we currently have on the market at the moment. But dealing away with that problem is probably achieved by us getting back into an environment where our inflation is a lot more manageable.
So talking about the Victoria Falls Exchange listing, which Fano is already preempted, maybe Kieran, what are the other strategic imperatives that are sort of informing the migration, besides maybe making it easier for reporting purposes and making sure that the business, the analysts and the investors are able to see exactly what you're doing? What are the other key strategic imperatives driving that?
I think there's a number. One is as you look at the trajectory of the businesses that are now migrating from ZSE or even not necessarily from ZSE, but to Big Four Stock Exchange, it becomes imperative that as a bank you're actually there as well. And to us that's one of the key things. It's also about what Fanmal talked about, but being a dollar then denominated entity, you also help attract investment. From an equity perspective, it opens up that opportunity to you. It also opens up the opportunity for our shareholders to earn dividends in US dollars, and that's a big benefit to our shareholders. If you think about it broader, and this is about medium to longer term, if we can stay the course and the confidence in the Big Four's stock exchange grows and the economy, and there's a couple of ifs in there, but think about what it can do from launching bonds, as an example, inward investment in the country, bringing, you launch a green bond, for example. Are people confident to invest into Zimbabwe? You invest that back in the country, and then your bondholders can take the capital and indeed their interest as a return out of the country. It's critical. That to me is one of the big benefits. There's also the associated benefits with the transaction costs are lower, and there's various other benefits of that. But to me, high level, that's really where I see it. I don't know whether Sandra, you want to add anything.
Well, I think you've covered it, Kieran. I think it's really positioning for the future. Really, we're saying that we've got confidence that better days are coming ahead, and there are these nuances on the market currently, which we believe are short term. They will be fixed in the fullness of time, and there will be pain as that happens. But at some point, a real economic traction is going to come through, and we would like to be positioned in such a way that we are able to interact with providers of capital, and we actually can support industry in a much more impactful manner.
So there's a big debate happening on the global stage about the future of banking. On the one hand, you have the big legacy banks. So if we just think about it from a global perspective, the biggest banks in the world, your JP Morgan Chases and Wells Fargo and Bank of America and that sort of thing. And then on the other side of the equation is your fintechs. These they're mobile firsts, they're digital wallets. Think PayPal and its Venmo app, or Block and its Cash App, and they're very different in terms of their culture and the way they do business. And there's a school of thought that says, look, the legacy banks are always going to be important and relevant. And then there's another school of thought that says, look, the legacy banks are dinosaurs. The future of banking is these new tech-savvy players. How do you guys see that argument, and where would you position FCB in the context of that debate and discussion?
I think before you get into the FCB and where you position that, I think you also have to just distinguish between where we are as a market and where your US, your UK, your European markets are, because they're fundamentally different. Okay, and for some of the reasons we've just discussed, we're still very much a cash economy. So as long as you're a cash economy, that fintech is going to be restricted to some extent. Let me just give you a real life example. I was back in the UK last Christmas, spent time with my family, and in the 2 weeks I was there, I never went to the bank once. I didn't use cash once. Everything was paid for either with a tap and go or with my mobile phone, etc. That won't happen here because I've got to go and get cash. Yeah, if it's AWL you can transact, but if you need to pay dollars, you've got to go and transact in cash. So we're a little bit away, and comparing where they are in Europe to where we are here, I think it's a longer discussion than we maybe have time for today. But to your point, if I look at Europe and where they are, and this is a personal view, I agree there will always be a place for the bigger banks. There has to be, because a lot of the fintechs where they are at the moment, they're helping the small to medium-sized enterprises, but also very much the retail customer, and making the transactional capability so much easier. Yeah, because you can do so much on your phone. But if you go to the bigger banks, there's still going to be need for funding, and that funding will be bigger maybe than any one bank can do. So you need that syndication, you need that working together, you need the big deals, for the major corporates. So there'll always be a place, but they have to innovate. If they stay as they are, they will be dinosaurs and they will slowly die out. And I don't have the answer, but I suspect if you go back to the 70s and 80s and look at some of the big banks that were there, they've either been swallowed up or they've gone by the wayside because they didn't innovate and they didn't stay relevant.
Yeah.
If I look at where we are now, Zimbabwe is behind that curve, but it will get there. It will get there. There's no question in my mind. And you look at what's happened in the words like EcoCash, for example, and that before it's time talking to necessity drove that innovation, if you like. So I think we will catch up. We will catch up. But I don't know whether I'm answering your question. It's a little bit of a long-winded answer, I'm afraid. But I don't know whether my friend over here wants to add to that.
I think it's about really striking a happy medium between traditional banking and digital banking at a particular point in time, because the demands, will obviously shift and continue shifting as we go into the future. And it's interesting. I mean, as you talk about that, I mean, one of the biggest and fastest growing banks in Europe, they basically just changed course and said, look, whilst everybody's talking digital, we're going to be putting branches all over the place. And they actually managed to grow quite fast. There's also a bank that came onto the market in Europe as a digital bank, and after a couple of years, 4 or 5 years, decided, well, look, just this alone is not working, and they began to introduce traditional channels. So I think it's a conversation that's always going to be with us as we go forward. But for us, it's about striking a happy medium between the traditional offering and the digital offering, making sure that our customers have got choice. They are customers that really want to just be digital fully. We give them that option to do so. And then there are customers that like to talk to their bank. We are there to
start the conversation.
Yes.
Yeah. Maybe let's talk asset creation. So I'm seeing here your loans have been growing.
Yes.
And we want to understand what's your target loans to deposit ratio is, and whether it's going to be changed by the transformation in the current situation. And specifically, I also want to get a comment on agriculture as a sector that you are lending to, because I saw it actually recorded some growth there. What shape does it take? because there is probably a misconception sometimes in the market that it was always going to be difficult. Maybe agriculture has got some certain nuances. Maybe what has been your experiences and what is your typical um, um, uh, interest or product in agriculture lending is looking like. So maybe target loans to deposit ratio, how that is affected by the current situation, and also what you see or how you see agriculture as a sector that you would want to you are already playing a part in.
Okay. So we typically manage our loans to deposit ratio at currency level.
Okay.
The reason being that the behavior of these currencies is actually quite different. If you know what I mean. And also the type of business that's supporting you for the supply of funding in those currency baskets can actually be different from time to time. Okay. So we typically manage at currency level.
Okay.
For the Zim dollar portfolio, we are happy to go above 70%. Okay. But there is always a backstop where we have this as a metric, but on a day-to-day basis, we're also looking at our liquidity position and actually moderating that ratio, scaling down or accelerating depending on the liquidity outcome at a particular point. Same thing for our foreign currency book. We typically would operate around 60-65% thereabouts. Yeah, but of course you'll notice with the foreign currency book, where there is a requirement for long dated assets, we've also brought in the capacity from some of our international and regional partners to provide us that strength, that capacity to stretch the pace a little bit more.
Okay.
Yeah. Then I think, Karen, you want to talk about the agro lending?
Yeah, no, look, agriculture, as we know, is one of the cornerstones of this economy, and I'll go back to many, many years ago when it was the breadbasket of Africa.
Okay.
So it's important that we look at that sector. It's also important that we look at the export potential in that sector.
Okay.
So combining the two is where the key is. So yes, we've gone, I think you've seen in the numbers, from 16 to 21% of our total loan book. But I would stress that the loan book is also, outside of that, quite diversified across a number of sectors. So I don't think we'll look to go much beyond that, because we have to make sure we've got a well-diversified portfolio and loan book. But it is a good export sector. We're quite careful about where we work and who we work with, and understanding the business, understanding the shareholders, understanding the people, the plans, etc. It's one of the cornerstones of what we try and do. It's very much work in partnership with businesses. So they get to know us, we get to know them, and common solutions where it works for them and it works for us. So you build a partnership, you understand each other, and you can support each other as you go forward and work together. So yeah, so agriculture is important to this economy. It's vitally important to this economy. So that's really where we are at the moment, and I think we'll continue to look at it, but we'll continue to assess it as we go forward. You know, you are always looking at sectors, at the economy, at businesses, where you are, etc., and making value judgments based on what you see.
And then dividends, we see the cover improving from 3.6 times to 2.3. What's your dividend policy? Do you expect the cover to improve? What sort of signal would you want to send to the investor in terms of how the dividend payouts are going to be handled going forwards?
Look, I think that's just one back a second as well. Remember what I said earlier.
Okay.
For 20 plus years, this bank did not pay dividends. So in the last couple of years, we've started to pay dividends, and we're returning money to our shareholders.
Which is good.
And remember, our shareholders, as I say, are 52% group, there's 15% employees, and then the balance is really spread across multiple shareholders. So I'm not going to go into specifics of what the dividend policy is, but when we make dividend decisions, we have a general rule that we will follow.
Okay.
And that's about retaining money in the bank, so future enable a capability to invest going forward,
Okay.
and distributing enough back to shareholders. Now, when you make that decision based on where your profitability is, but you also have to make that decision based on where your core capital is.
Okay.
As we said earlier, we have to keep capital at 30 million.
Okay.
So you have to keep an eye on both. And the basic answer to your question is, as long as we can continue to grow our balance sheet in a robust way, and our profitability in a robust way, we will continue to distribute. So as long as that continues, I expect the dividend cover to improve as we go forward.
So to your viewers, you have it. As long as they can continue increasing the balance sheet and the cash, the dividend is going to keep coming away. Thank you so much, Kieran and Fano, for coming through, and my colleague Rufaro for the discussion that we've had. Our viewers, we want to hear from you, comments and questions, anything that you want some clarification on. Otherwise, thanks so much for watching this show. See you next time.